Also, when we talk about investors and the sentiments that they have, specifically on the last 1.5 or 2 years that we have seen in the market, specifically any investors or anybody who has entered the market in the year, let's say 2020, in the March 2020, they have already seen a bull run, like from lows of around 26,000 Sensex in the month of March 2020, and now that the market has reached almost 60,000. Today was also around 59 k was the closing. So if we look at this and the coming year as well, so can we expect a similar kind of growth in the market, or whatever the growth will be? What will be the key drivers in the equity markets, specifically in the year 2022? So let's say we have already discussed about the challenges about the COVID and interest rates hike and everything, but what are the positive factors? What will be the key drivers which will actually be contributing to the growth of equity markets?
Right. I mean, to answer your first question, no, I don't think we should expect the kind of vertical rise that we've seen over the last, 6-7 quarters. And the reason for that is that, this was a Goldilocks scenario, right? Where policy support was very aggressive, rates were low, and on top of that, there was hope of economic normalization. I think what's going to happen going forward is that, as I said earlier, policy is going to be normalized. So that's going to act as a drag on valuations. But at the same time, if economy and earnings continue grinding higher, then the markets can still be all right. So in the base case, you should expect markets to, yes, continue trending higher, but not at the same pace as it has been in the last 18 months. Now, what can be the positive triggers? I think for India, the most important positive trigger has been that there is this concerted push around manufacturing. The government is doing its part with respect to PLIs and tax cuts and so on. Globally, India is emerging as a viable alternative to China, as a lot of global companies and global countries look to diversify away from China, because this pandemic has very clearly proved that supply chain management doesn't mean just cutting costs and relying on one source. Supply chain management more means diversifying across sources, so that there are any challenges you can you are well diversified to take care of them. So to that extent, I think people are looking for alternatives, and India is emerging as a very viable alternative. And then you have other factors like cost of capital still being at multi-year, in fact several decade lows in India. So all of this put together, right, this thrust on manufacturing is something that very clearly is something that we shouldn't underestimate, and that's something that can propelling the India story for the next few years. The second thing, which is equally important to keep in mind, is that today you are at the cusp of that $2,000 per capita GDP. And history has shown that countries that move from that $2,000 per capita GDP higher, they tend to have a very non-linear effect on stuff like discretionary consumption and investments and so on. So from that point of view, also I think we are looking at a very interesting few years with respect to the consumption story in India. So both these things, right, the manufacturing piece coming together with the consumption story, I think does give us hope that there are positive triggers out there. But again, as an investor, for these things to play out, you have to be patient. You have to have at least a 3-year kind of an investment horizon. The short term can still be full of hiccups.
Right. So as it's always said that, when you're investing into the market, long-term horizon that you should always be keeping for investments. So I think that is what we'll have to keep in mind right now. And also, like you mentioned, that the growth that we can expect in future will be on a moderate basis. We cannot look at a very high spike, but yes, moderate growth in the long term is what we can expect, right? So yeah, that's good to know. And thanks for sharing that micro overview also of the market here. And one more thing related to when we talk about global impact as well. So major contributor has always been FIIs. So what will be the impact of FIIs? Maybe buying, selling. What will be the momentum specifically post Fed tapering?
Right. So yes, I mean, there is no denying the fact that FPIs have been a very important class of investors in India. But I think what's happening incrementally is that the domestic flow is providing a very significant counterbalance to the FPI flows. But specifically coming to your question on FPIs, I think there are two factors here. One is the fact that central banks are looking to normalize policy, which is acting as a drag on overall FPI flows. But again, my base view is that if economic momentum continues, that there will be sufficient money around to chase that economic growth. And to that extent, to the extent that my base case is that policy normalization will not put spanner into the works for economic momentum, you should see that FPI money will continue flowing into areas where there is growth, including emerging markets like India. The second thing, which is a bit more tactical in nature, is the fact that India has already outperformed its emerging market peers over the last year or so. So I think in dollar terms, we would have outperformed the emerging market benchmark by close to 30 percentage points in 2021. What that means is that if you look at India's valuation premium on short-term earnings-based measures to other emerging market peers, you are standing at a very record premium. I think what you saw in the last quarter was that people were actually trying to, FPIs were actually trying to book some profits on the back of that record valuation premium. And in the short term, that can continue to be a challenge of sorts. But to the extent that, as I said, right, I mean, India is still a very attractive long-term growth story. I think those short-term valuations are tactical things which will correct in the medium term. But overall, I think from a longer-term point of view, again, I don't see any reason for FPIs to shy away from a market like India.
Okay. So that's good to know again. So really insightful as well. And one more thing, when we talk about investment specifically, this is the most common question that people have when talking about retail investors and also beginners or intermediate investors who are investing into the market, either directly or maybe through mutual funds as well. Most of the times they would have this very common query, as in what sectors, will outperform in the coming year, or which all sectors that they should be investing into, or maybe few sectors that they should completely avoid. Coming to the very crux of it, that where should we actually invest and which sectors look promising in the year 2022. So what's your view on this?
My general comment on that question is that I think investors should typically focus on diversified funds rather than trying to time the cycle with respect to what sectors to invest in and what not to. But to the extent that this is our sort of job day in and day out, and you ask me a very specific question, so my response to that would be that if you look at the last 10-12 years globally, they were marked by relatively low growth, low inflation, and in some countries close to zero interest rates.
Right.
I think what is very clearly changing now is that you are graduating to a bit better growth, higher inflation, and most likely higher interest rate environment. So the winners of the last decade or so, they were very different. The winners of the future can look very different. More specifically, I think now is the time to be more inclined towards pro-economy and pro-inflation assets. Again, I gave you some concrete examples on that. So manufacturing is something that's coming together for a country like India. So anything that's linked to that, to the investment cycle, I think is favorably placed. Similarly, discretionary consumption has been a structural story in India, and now I think you are at that cusp, being at the $2,000 per capita. As you graduate higher, I think that you can see a hockey stick kind of an increase in discretionary consumption. So that also continues to be very favorably placed. But in general, anything which is to do with economy, which is to do with inflation, that entire trade away from deflation assets into pro-economy assets is something that you will continue to see playing out over the next several years.
Okay. What about banking and pharma sector? Do you think that it could actually regain its lost shine, and should someone invest into particularly pharma sector now or banking sector here?
Yeah, I mean, interestingly, we are positive on both those sectors. I think pharma obviously falls in that manufacturing field. That's one of those sectors where, from a manufacturing point of view, we have already proven our prowess. I think this pandemic has anyways brought more and more attention to that entire healthcare space. Within that also, I think the fact that India is the sort of healthcare or the pharma factory of the world has also been demonstrated over the last 18 to 24 months. And you're incrementally seeing that all the concerns around FDA regulations on Indian plants, etc. A lot of that is waning away. So which was a big overhang for the sector. So overall, yes, we think that pharma is in a sweet spot, and we continue to be positive on that space, both domestically focused pharma companies as well as externally focused pharma companies. So that's one space that we like. Banking has been a very significant underperformer over the last year or so. And going back to my earlier response, I do think that anything which is facing the economy should be constructively looked at for the next at least 3 to 5 years. And banking from that space obviously looks very well placed. So far, whatever uptick that you've seen in banking stocks has largely been on the back of lower asset quality fears and earlier fears. So that asset quality has held up very well. I think the next leg of re-rating will be when credit growth picks up. Today, as it stands, corporate India is relatively well capitalized with respect to good cash balances to take care of short-term capital expenditure requirements. But eventually, they will need to turn to lenders like banks to meet further sort of capital expenditure requirements. So at some point, you should expect loan growth to pick up, and that, in our view, will be the next leg of re-rating for banking stocks. So on both sectors, pharma and banks, we continue to be positive, at
Positive.
least for the next 2-3 years. Yeah.
Okay. And any particular sector to avoid right now, if you can, just pick in any one particular sector that, one should stay away from.
I mean, as I said, right, we will stay away from two pockets. One where valuations have re-rated to insane levels, and because our base case is that as policy normalizes, you will see valuation re-rating. So it will become very important to focus on companies which deliver high growth, because it's only high earnings growth that can sort of weather the downward gravity that valuation re-rating will bring. So anything which is moderate growth or low growth but highly valued is something that we will avoid. Secondly, there are a lot of these companies where when interest rates were low, you could discount the next 5, 10, 15, 20 years also, because lower discount rates allow you to look that much into the future. So once those interest rates start rising higher, anything where near-term profitability is a question mark, and those companies turning profitable is some distance away, I think that's another space that will see some pressure, and that will include a lot of these new age companies which have seen a lot of IPO activity over the last few months, where profitability is still a question mark. So I think those valuations will definitely get questioned. So the bottom line is that you should now focus on companies that deliver earnings growth, because valuation re-rating is a thing of the past. If anything, valuations will way down as interest rates start moving higher.
Yes, right. So thank you for sharing that. And to our audience, I would also like to mention here that sometimes, these things becomes a little technical for you to understand, or maybe you cannot figure out, which particular sectors or, companies will be doing well in the future. I think, you can correct me if I'm wrong, that mutual fund will be the, best route to invest if you're not able to, figure it out yourself that, which particular sector I should be investing into. You can always invest through a diversified equity mutual fund, and, where the fund manager is actually taking the calls and making the best use of how to invest into the market and generate returns beating the benchmark and everything, right?
Sure, I mean, I completely agree on that.
Yes. So another thing, like now we are in the month of Jan, and in the Feb we'll be expecting union budget. So what is your expectations from the budget, and how do you think it will impact the markets? Like every time when the budget comes in, it somehow impacts the market as well, and everyone is on the lookout as in how it will impact the markets, or whether the impact will be short term, long term, how it will be. So what are your expectations this time around?
Right. I think going into this budget, one positive aspect is that tax collections have been really strong. They've been better than budgeted. So to that extent, I think government finances are in decent shape. I think from a fiscal deficit point of view, numbers will still be higher, because we are also, as a country, doing a lot of cleanup over the past couple of years. We cleaned up the FCI mess last year. This year, hopefully, the Air India liability, etc., will get cleaned up. But beyond that cleanup job, I think, because of those buoyant tax collection, I think government finances are in decent shape. Now, they could be used in one or two main directions. I think one, this entire thrust on manufacturing and infrastructure should continue. And one important prerequisite for manufacturing to pick up in a country like India is for infrastructure to be good. So I think that spend on infrastructure is something that we will be expecting, and that will be keenly watched out for. The second piece is, if you look at consumption over the last 18-24 months because of the COVID pandemic, you've seen one set of relatively high salaried individuals that have continued to, that piece of consumption has continued to hold up well. But the bottom strata has really suffered. So I think, if there's something directed towards the lower end of consumption, I think that's also something that markets will be keenly looking out for. Beyond expenditure, I think there are other things like, does the government also, do anything more with respect to the reforms around India's inclusion into the bond index and so on, which will matter from a market standpoint. But broadly speaking, I think these are the 2-3 pockets that we will be keenly looking out for.
Right, right. So thank you so much, Gaurav. And I think we have already, discussed about the macro part of it and how the market outlook will be for the year 2022. Now coming to the actual, investors' queries, because many a times we have received some emails and some queries from the investors as in, how they should be investing. So one question from there, one of the most, frequently asked question that we have received, specifically from young investors who have just entered the market last year only. The question is, most of the times, basically the millennials, they are more attracted and lured towards, IPOs, or maybe they are more lured towards cryptocurrency. That's the rage that is going on right now, and maybe stock investments, direct stock investment as well. So, just one, piece of advice or a financial advice to young investors, as in how they should be, managing their finances, and what should be one big advice from your side to these beginners and young investors who are just starting out with their investment journey?
I think there are many questions in that question. Speaking about what's done well over the last 12 months, I think everything has done well over the last 12 months, including a lot of these companies where there is just hope of profitability coming at some point in the future. So I think the single biggest advice at this juncture of the cycle would be that as interest rates go up and as money ceases to be as cheap as it has been, anything which is speculative in nature, which is more story driven and where there is a promise of delivery at some point in the future, but not now. I think that's the pocket that one should clearly avoid. Focus on companies where fundamentals are strong and where earnings delivery is imminent. So I think that's one simple advice from a here and now point of view. From more longer term point of view, I think the advice is very simple. Stick to your longer term asset allocation plan. Don't react to news flows and stuff that happens in the short term. Be focused on what your long term goal is and what is the right asset allocation that will help you reach that long term goal. That long term goal.
Yes, that's a great piece of advice that yes, everyone should stick to their asset allocation. That's very important that you should not be overexposed to one particular asset class. And yes, a right balance among all the asset class will definitely give you good returns, as you also mentioned. That's a very right advice here. Another important question, again, investment point of view, from investors who are already being into the market from quite some time. So intermediate, you can say intermediate investor, experienced investor that are there. So what will be your advice for them, for retail investors, how the year 2022 will be for them, and if you can also tell them about how much return can they expect from the market, if possible.
I mean, unfortunately, I don't have a number to what returns should they expect from the markets. As I said, the factors are clear. Hopefully, economic growth and earnings growth will continue to be robust, but there will be valuation derating as interest rates go up. But on balance, our expectation is that beyond the near-term turbulence that you will see, equity should be fine even for 2022. But more importantly, I think my advice would be that eventually, when you think of equities as an asset class, timing has rarely helped. What helps, and it's a very cliche that I'll borrow, is that how much time you spend in the markets. The more time you spend in the market, the more is your probability of going right. So I think that's what any investor, however time they spend in the market, should keep in mind, and they will definitely reap the benefits.
Yes, definitely. So thank you so much for the valuable piece of advice that you have given. So I'm sure that the audience that is listening to you will definitely be benefited from this. Okay, so another important thing that we can discuss here is about what are the key risk factors that you oversee in this year 2022.
Yeah, I mean that's an interesting question. If I were to look beyond any short-term volatility and short-term turbulences that can come through, because it can come through from a variety of factors. But beyond that, one key risk that we think of in 2022 is if COVID ceases to be, COVID is not a passe, COVID continues to be a big one. Because I think what COVID has done is that on one hand, because of all the artificial restrictions that it has put around people moving, goods moving, and so on one hand, it is sort of stifling growth, and on the other hand, it's causing supply side disruptions, which is also leading to inflation. So if COVID continues, and so far, thankfully that doesn't look like the base case because the new variant is much milder than the earlier variant, and vaccination coverage is pretty high. But you never know; it can just mutate. So that's a risk to keep in mind, because if COVID continues to be a worry and restrictions continue, then it can lead to a stagflation kind of a situation, because it also impacts growth and it's also leading to high inflation. And that stagflation is something that can cause global policymakers to get ahead of the curve rather than stay behind the curve and do whatever they can with respect to curbing inflation. And that in turn for countries like India and other emerging markets where the recovery is still in a nascent phase, that can just sort of curb that growth. Now, that is not a base case, but you never know. You asked about a risk. So I think that's the key risk that one should keep in mind going into 2022.
Yes, definitely. And I think because the COVID since 2020, this has been a major, drive in the market as well. So thank you so much, Gaurav, once again. And I think the session was really insightful. And I'm sure everyone who is listening to us is definitely have got a better idea about how the market will be in the year 2022. And it will also help them to make correct decisions of how and when and, where they should be investing into the markets. So thank you so much once again. And
Thank you, Nidhi. Thanks for having me. And once again, a very happy 2022 to all your viewers and you. And wish you all good health and happy investing.